VA assumable loans are a hot topic right now, and for good reason. Who wouldn't want to take over a VA 30-year fixed-rate loan at 3% and have a much lower mortgage payment? For those of you that don't know what a VA assumable loan is, it's a VA mortgage that a buyer takes over from the current homeowner, keeping the original loan terms. The buyer assumes the loan's balance, interest rate, and the entire repayment period. So here's how it works. The potential buyer has to qualify directly with the seller's mortgage servicing company. A loan officer like me, we're not part of the process. The buyer has to bring in the difference between the purchase price and the mortgage balance. So let's say the home is for sale for $700,000, but the mortgage balance is $500,000. The buyer would need to bring in $200,000 to close. If the buyer can qualify and has the money to cover the difference, then the buyer assumes the loan based on its original terms, and the seller is released from the liability of the loan. The cool part is you don't need to be active duty military or even a veteran to assume the loan. You can be a civilian and still take advantage of the assumable process. So why don't VA assumptions happen more often? Well, the process could take 3 to 4 months, and most sellers don't want to wait that long when they have other buyers that are ready to purchase without assuming the loan. Also, not all mortgage servicing companies allow assumptions, and sometimes they don't even have the capability to make it happen. So sellers have to check with their mortgage servicing company before advertising that someone can assume their loan.